So bonds are definitely used for business purposes, usually to fund very large capital acquisitions, like purchasing land with a building or an expansion into Mexico, or usually for large capital structures, things that would go on the balance sheet is generally the use of bonds. Any other questions? So last time in that lecture, we talked about what are bonds. Okay, David asked a really good lead-in question on the difference between bonds and a note. So again, bonds involve very large dollars, usually for large time frames. They're issued in small denominations, right? So if a company wants to borrow $2 million to fund a project, an overseas project, or to fund a development of a building or something, there's not too many people sitting around with $2 million that they can just borrow from one person. So they'll float a bond, and to make it affordable, they'll usually float it in denominations of $1,000. Let me click out of my email so you don't have to listen to those buzzes. So they would float a bond. They'd offer it in denominations of $1,000. What happens is sometimes it takes a year or two to float a bond, to get the paperwork and the underwriting and everything that needs to take place out there. So they'll stamp an interest rate, a fixed interest rate on the bond. And then in the meantime, during the year or two that it takes to get the bond out there, interest rates change. And so what happens, as you'll watch in that lecture, bonds either sell at a discount or a premium, depending on what the market's doing that day. Discounts are when they sell below their face value, and premiums are when they sell above their stated value. And so we also learned that interest payments are made throughout the life of the bond, sometimes annually, but usually semi-annually. And I think, David, I might have seen you raise a hand. So let me stop for a second and you can ask your question.
Yes. So when do they sell bonds below the market value?
So that would happen. They don't necessarily sell them below the market value. What happens is on that bond, it is stamped. Let's pick a rate out of the air. It's stamped at 5%. And then what happens is in between the time it floats, the market is offering, let's say, 8%, right? So if your bond promises to pay 5% and all the other ones out there on Wall Street are paying 8%, no one's going to stand in line to buy your bond because they can get a higher value out there in the marketplace. And so just like what we would do if we were selling a car and nobody stood in line to get our car because it was overpriced, the price is going to drop. You're going to accept less. Well, the market does that. And if you want an example of how the actual calculation works, it's in the appendix, but just which we're not covering in class. But generically, that's what happens. Nobody waits in line for that bond because it's paying too low of an interest rate. So to keep that bond competitive, the market automatically drops the amount. And that's what happens up for a discount. It sells below the face. Not that that was the intent, but because something happened in the interest rate market between the time that bond was created and the time it was actually issued onto the open market.
Thank you.
Yeah. Any other questions? That was a good question. Okay, so we said interest payments are paid usually semi-annually on most of the bonds that I've seen, which is twice a year. There are some bonds where it's paid annually, and then there's usually a lump sum payment at the end of the bond. So the reason I brought up this agenda is just kind of an outline of what was discussed in the lecture I sent you. Discounts and premiums are adjustments to the bond price because it either sells above or below the face value. And what you'll see demonstrated in that video is straight line amortization. And what that means is you take the discount or the premium and you just divide by the number of payments. And that's going to adjust the interest expense up or down depending on whether you paid a discount or premium. And in the previous lecture, as Juan just told us, all the exercises and problems are worked out just as if we were in class, and Juan posted those as he always does in the discussion area. So make sure you take a look at that. I would start the homework early on this chapter because it is 100% new. And that way, if you get stuck or if there's something you don't understand, You can Zoom with Juan during his tutorial hours, or you can Zoom with me. I had 3 people in my office this morning. We were discussing various things, but one student needed some help with the discounts and premiums. And then again, I can't tell you on these next 3 chapters, practice, 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 build the practice in during several chunk of hours of time during the week. If you wait till Sunday night and you try to do all this homework, you're going to be overwhelmed and confused, and then back yourself into a corner, because at 10 o'clock on Sunday night, you probably can't get assistance with that. That's day 1. Okay, here's what we're talking about today. So today, the second half of the chapter is on installment notes. And these are the types of notes that we will all have once we buy a car or we buy a house. So an installment note, unlike the bonds that we just talked about, has principal and interest built into them. So they're usually long-term. If I were to go right now to a car lot and buy a car, it'd probably be a 5 or 6 year loan. So in that way that they're long-term, it would be at a fixed interest rate. So if I could go to my credit union and get 3.9%, you know, that amount of interest would be built into all the payments. Each payment includes both principal and interest. So today we're going to practice computing the payment. We're going to do the journal entries for both the issuance, and we'll also do them for payments. We'll compute these things called amortization tables for the payments. We'll learn what to do if we need to accrue interest between interest dates. In other words, since these are long-term in nature, there's probably going to be an accrual necessary when 12/31 comes around, because what we need to accrue, just like we did in the notes chapter, we need to accrue interest from the date with the note was signed until the end of the year. So any kind of interest that we owe, or from the date the last payment was made until the end of the year, depending on where you fall in the life of the note, we'll have to accrue that interest. And then there's a couple ratios in the chapter, debt to equity, which I think we're doing a homework exercise on. And then another one that I don't think we did one on called times interest earned. So that's where we're headed today. Remember, in the whole scheme of things, we're working our way down the balance sheet. We're now in the long-term liability chapter, and there's 2 major parts in this long-term liability chapter. There is the chapter, or the half of the chapter, on bonds, and then the second half of the chapter is on notes. So before we jump in, any questions on that? Okay, so again, installment notes, what are they? Okay, that's the first thing I want to get into your head. What are they? It's a type of loan that's paid over a period of time, and the payments have principal and interest built into them. I think that most of these other items can be done by just going through an exercise and talking our way through it and working our way through it. So when we do the second half of this chapter, I want you to think about a car loan, either one that you may have taken out or maybe one that your parents have on their car. So every month they pay the same amount, hopefully more, but every month you have to make a minimum payment, and that minimum payment includes principal and interest. Most car loans in the state of California are between 5 and 6 years. So 5 years would be a 60-month installment loan, and 6 years would be a 72-month installment loan. We're going to learn to calculate the payments and do the journal entries. That's where we're headed today. Let me stop, see if you guys have any questions before we jump in and take a look at these installment notes. Okay. Here's our first screen then. You guys have these files. Hopefully you've come prepared to class and ready to work. And Juan, can you verify that you see the little recording button somewhere? Okay, good. All right, it says on January 1st, 2019, Eagle Company borrows $100,000 cash. Okay, so there's the principal. I'm going to put a little P there. Principal by signing a 4-year, that's the length or the term, 7% installment note. Okay, so an installment note, again, just to get this into your notes, is a type of loan that has principal and interest built in to each payment. So the payments are the same over the life, and we're going to work through how to calculate the payment. Now, on this one, they gave us the payment. They said the note requires 4 equal payments of $29,523. So they gave us that. I want you to be able to compute the payment as well. So even though they gave us the payment, it's important for me that you know how to calculate that payment. So I'm going to show you 2 ways. I'm going to show you using the table that you read about in the chapter, the amortization table, or actually it's a present value table. I'm going to show you that first, and then I'll show you how to do it in Excel. Okay, so I do expect you guys to understand how to compute the payment. So first way we're going to do it, using the present value table for an annuity in Appendix B. Now they'll show it to you in the homework. There'll be a little thing that you can click on to look at it in the homework. So here's how you're going to do it. You're going to take the principal amount, I'll call it the loan amount because that's easier to understand, on the top, and you're going to divide by the present value of an annuity, where I equals the interest rate, 7% in this case, and N equals 4. Okay, so there's an annuity table that all of you have access to. I pulled it up before class. We'll see if it's still there. Sometimes the site times me out, but we're going to look on that table. We're going to run our finger across the top of the table till we find the 7% column. And then we're going to run our finger down the side until we find the 4 payment mark. Okay, so give me a second to go look at that table. I opened it up ahead of time. So here it is. This is table B3. You guys all have it in the back of your book. So just look at it on screen right now. I'm going to make this bigger so you can see it. We're looking at 7% over 4 years. Okay, so here is the factor, 3.3872. 3.3872. I'm going to take that back to our homework. I'm going to put that on the denominator here, the factor that we got. It's not going to let me copy it, so I'll have to remember what it was. 3.3872, I think, is what I remember looking at. Let me go back and look at my notes. Yes, 3.3872. Let me make that some more decimal places so it matches exactly. Wrong way. There we go. So loan amount, 100,000 on the top. Here's the present value of an annuity factor. Pop that into your calculator and you will get that exact same payment that they gave you in the problem. Okay, 29,523. It matches. I want you to notice that it matches. So that's one way to calculate the payment, is using that present value of an annuity table. You'll learn more about how that annuity table works and how the numbers are derived in Accounting 102. Suffice it for now, you can just look up those factors and calculate that payment. Now let me show you a much easier way. We can use Excel, and Excel has a feature built into it that's very easy to compute a loan payment. So I'm going to demonstrate that to you now. And it's called the equals PMT formula. So equals PMT, that stands for payment. And you're going to put 3 things in. You're going to put the interest rate, the number of payments, and the loan balance. And I'm going to do that right now. Equals PMT. Our interest rate was 7%. The term of our loan was 4 years. They're making annual payments to make your life easier, annual payments. And the loan balance is 100,000. So if you guys have Excel open right now, if you're working on this spreadsheet, you can type in equals PMT, the 7%, because that's the interest rate, the 4, because it was a 4 equal payments, or making 4 payments, and the loan amount's 100,000. When I press enter, it's going to give me that amount. I'm waiting for a second so that you guys can write that formula down. And if anybody needs me to go back to that formula, I can show it. But here's the same amount that we just came up with. It might be a dime off because of rounding, but there it is again. So first thing I expect you to be able to do is to calculate the payment on an installment loan given the terms of the loan. They gave it to us, but we also calculated it 2 different ways. We calculated it using a present value table that's located in the appendix of your book. And we also calculated it using an Excel built-in function. That's very useful. If you guys take the Excel class, we go into a whole lot more detail on how you can manipulate that to find out savings on a loan balance, how you can pay your credit card bills off earlier, how much quicker you can pay off a car loan if you add in an extra $25 to $50. There's lots of things we do in the Excel class with that. All right, so if we continue reading, the note requires 4 equal payments. We just computed it. They want you to prepare an amortization table. Okay, so an amortization table is going to show you the breakdown between principal and interest. You will be expected to do this on a test. You will have a 10-point test question where you do this. So how do you do an amortization table? You don't have to memorize any specific way to do it. Basically, an amortization table is going to have a date on it that your payments are due. I'm going to put a payment number just so we can keep track of the payments. Okay, we just calculated what the payment's going to be, so I'm going to write that in. And then basically all you got to do is split out every payment between principal and interest. Well, interest is easier to do first. The rest of it's going to go to principal. I'll show you how easy this is. Banks will charge you 30 bucks for them to create a table. You guys can do it in a few minutes. And so I'm going to start off with the loan balance here also. So you're going to see how easy this is. Okay, so I'm going to start off with a payment 0 because I like to do that. And then I'm going to show there's 4 payments. I'm going to leave ourselves room between for any calculations. And I'm going to show 4 payments. Let's see, we took this loan out on January 1st of 2019. And then each year we'll be making a payment. I believe it's probably due at the end of the year. Yes, on December 31st. So here's our first payment that's due. So the rest of these would just follow along. So we have our dates. We have our payment numbers in. I'm going to show my starting loan balance over here is 100,000. And then I know that my payment is fixed. That was one of the features of an installment loan, is equal payments over the life of the loan. Okay, well, we just calculated the loan payment to be $29,000. I'm going to get rid of the cents, $523. Okay, just to make it easier. I'm going to make these 0 decimal places. Okay, well, next step. Once you know that, in fact, I'm going to copy that down to all the cells because that's a given. Nothing's going to change that. So again, an installment loan is a series of equal payments over the life of the loan. Each payment has principal and interest built into it. We're going to show you how much principal and interest now. Okay, well, we know how to do interest. interest is principal times rate times time. Well, since the time here is for a whole year, the time is 1 year, or 12/12. So we can, that adds up to 1. Anything multiplied by 1 is itself. So you could actually drop the T on this. So our principal right now is 100,000. And the interest rate they gave us, I think, was it 7? Let's see, 7%. Okay, so times 7%. So that's what I'm doing on the calculation. 100,000 times 7%. Many of you can probably do that in your head. That's going to be 7,000. Well, here's my payment. Here's my interest. The rest of that is going to principal. So 29,523 minus the 7,000. I'll write that down so you don't wonder where that came from. It was the 29,523 less the 7,000. That gives us the portion of that payment that went to principal. And so what's left then is a new principal balance. I did owe $100,000 on that last payment. I paid off 22,523. So there's the math. Let me go ahead and let the computer do that. That's my new loan balance. Now let me stop, because the rest of this is just going to be repeated steps. So I want to make sure you understand the first step before we go any further into calculating the remaining payments. So again, we're looking at installment loans, equal payments over the life of the loan with principal and interest built into it, unlike a bond, which is interest only throughout the life of the bond with a big balloon payment at the end. This is not that. This is the other half of the chapter. These are installment loans. And so now we just repeat. So now our interest is going to be based on the new principal balance, 77,477 times that 7% again. And we'll just keep going. So 77,477 times 7% is 5423. What is that? That's the amount of that payment that the bank gets to keep. That's a financing cost. It's called interest. The difference, the rest of it, is how much goes against our loan balance. So let me take the difference and I'll write down what I did so that you have a good set of notes when you're doing this at home. So what I just did here is I took that previous principal balance and I backed out the 24,100 in, oh, let me go back and try that again. It was my payment here of 29,523 less that 5423 of interest. Okay, so what you notice is as we go further into this, the interest goes down, the amount owed towards principal goes up. Okay, as we do this over the life of the loan. The goal is to bring this loan balance down to 0. Okay, so now once I update this loan balance, here's what I did owe. Here's what I just paid off against that. So 77,477 minus the 24,100 that went towards that principal balance now gives me a loan balance of 53,377. So I'll write that down so you don't miss it. So what we just did, we took 77,477 and took out that 24,100. And we're going to do that 2 more rotations. If we did it right, we should get somewhere close to 0 on our last line. There may be a few bucks due to rounding, but we're going to finish the table up. And the table is going to be the source of our journal entries. Okay, so now I'm going to take my new principal balance, 53,377, times that 7% again. I'm going to finish it up. That's what I got. You guys can double check me. Then I'll take the difference. Again, repeating the same steps. You can see that as I pay my loan off, more of it's starting to go through to principal. This is why it's not a good idea to constantly refinance things, because once you start over the cycle again, lots of interest goes to the bank. They try and talk you into recycling to bump that loan up again. A lot of people pull cash out, which is not a wise thing to do. Okay, to finish it off, let me calculate my new balance. It was $53,377. I just paid off this much of it. Take the difference. There's my new loan balance. We'll do one more iteration of it. So now I have 27,591 at the same 7%. Remember, on an installment loan, the interest remains fixed. That's how much the bank gets to keep. This is how much the difference is going to go towards my loan. And you can see that when we take the difference between this, you'll have looks like $1 difference. So our difference is $1 here. That's due to rounding. We won't worry about it. That's requirement 1. Do an amortization table. Now, if you want to know how much interest did I pay on that $100,000 loan, and this is something you guys should calculate ahead of time, so you'll know how much that car that you're buying is actually costing you. It's not just the cost of the car, it's all the different financing costs that go into play. So they won't have you do this, but I would encourage you guys to do a total line here. Do a total. I'm talking about your personal financial well-being. Do a total. This would be before you buy whatever it is you have your heart set on, and see what the real cost is. Here's the amount of payments you'll make over the life of that loan. You can look right there and tell exactly how much the interest just cost you. $18,000 you're paying in interest. So when we think of our cars in that sense, not that it's, and I'm just using a car in this example, this would be a really fancy car for $100,000. Not just the cost of the car, it's not just the $100,000 that you're buying. You're paying the bank a whole lot of money to be able to finance that. And if you did it correctly, the interest should match what we just saw. Okay, like I said, we're $1 off because of rounding. And you could also calculate the principal. That's an amortization table. Everybody in here should understand the importance of an amortization table, and you should be able to do this in Excel. If you take the Excel class, you'll see a 60-month loan done. Every single line item. It's literally one row of formulas copied down. This will allow us to do the second part of the problem. So let me stop. See if you guys have any questions before we do the second part, which is the journal entries. Okay, so let's see what they ask us to do. We did the amortization table. Now they want the journal entry to record the notes issuance and each of the 4 payments. I'll probably do 2 payments, right? Just to not waste our time. So issuance, just like on the bonds, one of the journal entries that you're going to need to understand is what would the issuance of the note look like on the day that you issue it. Well, here's what it looks like. We got cash and we now owe money, installment loan payable of $100,000. And a lot of people don't understand, why are you just recording a loan of $100,000 when you just told me that we would be paying over $18,000 in interest? Okay, that's a good question. Why do we only record the liability at the $100,000? Right? Because you could always decide to pay it off early. That's what happens with most of my car loans. If I get a car loan, I work really hard to make additional payments toward it. and then we pay it off. You're not responsible for all that interest. You're only responsible for interest up until the time you pay it off. So this is to record the issuance of the installment note. That would have been done when you get the money, 1/1/19. And then we would use our table here to record the payments. So I'm not going to take your time to do all 4 of the payments. We'll do maybe 1 or 2. Okay, so first payment, it's in orange here. We have the data, we just need to know what accounts. Before I do that, any questions on the table or the journal entry for the issuance? Okay, then 12/31/19 comes around. Our first annual payment is due. We have the data. So I'm going to make this orange so you can see where the data comes from. We have the data. This is how much cash we paid. And of that amount, here's the interest and here's the principal. So we just need to record it. The interest expense in the orange amount is $7,000. The principal we paid that goes against the installment loan payable, if you look in the orange box, was $22,523. And then for every payment, it's going to be the same. That's the sum. We already know what it is. It's $29,523. That is to record the first annual payment. And then Juan, if you could check when you have a moment, that chat room, just to make sure there's nothing in there.
Yes. Maynard is asking, how is an extra payment determined? To be specific, what goes to the principals and what goes to the interest?
Okay, that's a really good question. So to answer Maynard's question, it's a really good question. If you have a table set up like this, let's say that you are just going to round your payment up to $30,000. Okay, we know right here that the payment's $29,523. If we decided we're just going to round it up to $30,000, this table would recalculate and show you how much sooner you could pay it off. Now, I don't have everything cell referenced because I was showing you guys my work. Let's see if this first one works. So if I change this to 30,000, Maynard, before I hit the equal sign, I want you to pay attention to this cell that I'm circling. Let's see what happens to it. So if I change this first payment to 30,000, there's still 7,000 going to interest. But do you see what happened to the principal? The rest of it, anything above 7,000, goes toward that principal account. And so what happens if I had this thing all cell referenced, you'd start seeing a negative number because you would pay it off sooner. So I hope that answers your question. If not, I can send you an Excel spreadsheet that is 100% cell referenced. So any payment you make above that required minimum, the interest is based on that principal balance. So it's going to stay static. What changes is the leftover amount given towards principal. That was a great question. Anybody else? So what happens is it drops your principal balance faster, which means you wind up paying less interest. In this case, I think that principal balance was 30,000 less. So now the interest goes down on your next payment and so on and so forth. It gets paid off quicker. Juan, could you check that chat room one more time?
Yes. So interest stays capped at the maximum amount?
So interest is always 7% on this loan. The next payment would be lower because the principal balance is lower. So as the principal balance drops, your interest drops because it's always calculated on the outstanding principal balance. All right, here's the second payment. Why don't you guys give it a shot? Let's see if you can record that blue payment. And I'm going to come off to the side here and record it with you, but you try and do it without looking at my notes, and let's see if we can get it correct. And Juan, you might want to mute yourself just for the background noise.
Oh, sorry.
Yeah, no problem. And don't worry about the cents. You don't have to use cents if you don't want to. That would be the second payment. You guys can check yours out. They ask us to do all 4, but in the interest of time, I'm going to do 2 of them so we can move on. And again, you don't have to worry about cents. I can take the cents off here if that's confusing anybody. We'll just use whole dollars. Money is very cheap right now. We see historical low interest rates. Lots of people are taking out home equity lines. They're borrowing money. What happens when you do that? And I've unfortunately seen it with my mother as well. What happens when you do that is you never pay off your loan. You're constantly refinancing for 30 years or 20 years. You get to be 80 years old, fixed income now, Social Security, and you still have a house payment. Our goal should be, at least one of my goals, is to have that house and the car and everything else paid off by the time I retire. That might be a goal for you. If you have a car loan, a goal for you might be, could you find $20 extra to pay a month on your car note? And if you guys take that Excel class, I think, David, you might be in there now. When we get to a project later this year, you're going to see how much quicker you can pay that car loan off if you can put an extra $20 or $30. When you talk about the prices of housing in Southern California, you can save tens of thousands, if not $100,000, simply by making a little bit more of a payment every month. And we do that through a schedule in the Excel class. If you guys are planning on transferring to a university, I would strongly, highly suggest the Accounting 133 class. I've been told by hundreds of students that it is a must, because when you get to USC or you get to Cal State Fullerton or you get to Cal Poly, and these are just the students in the past week, you are expected to be Excel proficient. You're expected to know all those formulas. Juan, your buddies, your Marine buddies at Cal State Fullerton right now, thank me probably every couple of weeks, because they're diving into these classes where they're using all Excel formulas.
Professor?
Mm-hmm.
Yes, on the payment that we did on the second one that we did on by ourselves,
Yep.
that's the third payment, correct?
Oh, let's see. Did I accidentally do the third one? Oh, you're right, Juan. That is the third payment. So let me change that to be third. I was looking at the line above. Yep. So thanks for speaking up. Let's go do the second one then, since that was my mistake. Let's go do that second one that I asked you to do, the first in blue up there. It would be 5423. Thank you for pointing that out. 5423, the installment loan on that blue one. I should have picked up the 24,100, and of course the cash would be the same. Thank you for pointing that out, so the people at home were not totally confused when they watched that. To record the second annual payment, and then I will put arrows up here just to demonstrate that I messed that up. It's hard to talk and work at the same time. Sorry about that. Okay, so installment loans, what are they? They're one lender, usually fairly short term. When I say that, 5 to 6 years, principal and interest built into each payment. That doesn't mean that you can't pay more than that. It's just that's a stated minimum. If you make the actual payments over the life of the loan, you'll know that you've had it right when that last column in your amortization table is close to 0. There may be a couple bucks off for rounding here and there, but it should be close to 0. Questions on anything we've talked about? All right, I did want to give you one example where you would have to accrue interest. So that's why I threw 10-5B in. Remember, when we have to accrue interest, we need to accrue interest. GAAP says you record expenses when incurred. So if we've accrued any interest between the date we signed the note and 12/31, assuming that they are a calendar year taxpayer, then you need to accrue that interest. So this one says on October 1st, Gordon borrows $150,000 in cash. Okay, that's the loan balance, by signing a 3-year note bearing 10% interest. And then they gave you the amount of that payment. Okay, I would tell you to see if you can figure out what that payment is. I'm going to use Excel just to prove it to you. So equals PMT, I got to put in 3 things. The interest rate, which is 10%, the term of the loan, which is 3 years, and the balance, which is $150,000. So that's what I'm going to put into Excel. I hope to get the same 60,316 here once I do that. I'm going to wait a second to press enter to make sure that you guys got that formula down. It comes in really handy for lots of things. And when I press enter, I do get, again, might be a little bit off because of rounding. So no big deal. We'll go ahead and use the 6316 here just because I want to be consistent with what the book uses. So we're $1 off, no big deal. All right, they want an amortization table. Well, most people don't go out on January 1st and borrow money. So this is a more realistic problem where during the year you borrowed money. That's why I'm showing you this. So let's get down our payments. I'm going to start off with 0. And since it's 3 payments, I'll go ahead and put those 3 payments in, leaving myself a little bit of room. I do want to get some dates in here as well so we can work with the accrual. So the date that we borrowed this money was on 10/1. So it's going to look like that. We're going to calculate our payment in just a second. So I'm going to put that payment. And then all you got to do on an amortization table is remember to split it out between interest, which is what the bank gets to keep, and principal, which is what brings your loan balance down. And someplace on here, I'm going to keep my loan balance because that's what the interest is based on. So when this loan was generated, we got $150,000 in cash. Our goal is to go create an amortization table first. Okay, well, every year they said the payment would be made on September 30th. So the first date would be 9/30 of 2020. And then 9/30 of 2021. And then 9/30 of 2022. And just like we did before, we're doing principal times rate times time. So on this one, we're going to do 150,000 times 10%. You might be able to do that in your head. I'll give you guys a second. I can do that one in my head, which is 15,000. Oh, sorry, that is the interest I just calculated. Let me move that over. The payment they gave us. If you guys are using Excel, just move that over. You can cut and paste, or just grab it like I'm doing, grab the outside of it and move it over. What should have gone in the payment box is what they told us, 60,316. I'm going to write that all the way down because it's not going to change. The principal, just like we did on the previous table, would be the difference. And our new loan balance would be the 150,000 less that principal here. The rest of this we can do at a later time. Right now, I want to show you how to accrue some interest. I wanted to get that first payment down so we can talk about accruing interest. So let me stop. See if you have any questions on where those numbers came from. It's exactly what we did in the last problem. The difference is we didn't get our loan on the first of the year. We got our loan on October 1st. So when you have a loan that falls between 2 fiscal years, it becomes necessary to accrue the interest. And that's why I gave you this one. We should be pretty good at accruing interest because we had that whole chapter on notes. We had one on notes receivable and one on notes payable. But I think it's helpful always to draw a line, draw a timeline. Here's 12/31, that's their year end. And they got this money on 10/1/19. So to make it easier, usually when we deal with installment loans, large installment loans, we can use months of accrual instead of counting days out. So what I mean by that, we signed this on 10/1 and our balance sheet date is 12/31. How many months of interest did we need to accrue? Okay, and I'm not afraid to get my fingers out. We needed October, November, December. We need 3 months. 3 months have elapsed between the day we signed this and year end. So when 12/31 of 2019 rolls around, that first fiscal year end, we need to accrue 3 months worth of interest. Okay, well, you guys know how to do that. We debit interest expense and we credit interest payable. We just need to figure out the amount. Okay, well, principal times rate times time means our principal was 150,000. Our interest rate was 10%, and the time, don't get the time messed up. The time is 3 months, 3/12, 3/12 of a year. Why 3/12? This is an annual interest rate. 10% is an annual interest rate. And we have October, November, and December. We have 3 months that we need to accrue. So let's go ahead and do that on our calculators. 150,000 times 10% times 3/12. I got 3750 when I did that, but I'm going to wait for you guys. Okay. So then the last thing I want to show you, just like we did in the notes chapter, what's going to happen when that first payment is made. Okay, on 9/30/20, first payment, this one. I'll put it in a different
Can I take a stab at it?
Sure. Yes.
So we debit interest payable, right?
For how much?
3,700.
The same amount right here, David? 3750. We
Yeah.
would, yep. Okay. What else?
And then we debit interest expense
Yes. How much do you think?
for let me do
Any idea, or you need a little bit of help?
Wait, hold on.
Okay.
Yeah, I need it.
Need a little bit of help? Okay, here's the total interest expense, 15,000. I'm going to circle it. And we just recorded in that accrual 3750. We did that in the previous fiscal year. That means the rest of it, the difference between 15,000 and 3750 still needs to be recorded as expense for this fiscal year. So I'm going to record that as 15,000 minus the 3750. Now we got the whole 15,000 in interest here and here. These two, the one we did in the previous fiscal year, and now the expense recorded here, that matches that 15,000. And then to finish that off, of course, we got to get that principal in there. So installment loan payable. And that's the hardest part, David. So I'm glad you wanted to try it. It's perfectly fine to miss it. That's why we're here learning. There's my principal. And we know that each and every loan is going to be for the same amount, for that 60,316. I'll sum these up. Hopefully they'll balance. To record payment number 1 after the interest accrual. So I would say out of this batch of assignments, it's that part, that interest accrual, which is a little bit of a stumbling block. That's why I assigned that problem.
Professor?
Yes.
So this company, every year, their journal entry will look like that because they got it on October 1st. Is that correct?
So every year, it will look the same as far as the accounts are going, but the interest expense is going to be lower as it's paid off.
Yes. It's just that interest payable and then interest expense because we're going to do that on December 31st.
Yeah, always for those 3 months as well. Yeah. Good point.
So the interest payable and the interest expense, I'll have to add to 15,000.
Yes, the sum of the interest expenses. So this interest, this 15,000 here, got split over 2 fiscal years on our timeline. That 15,000 got 3750 in this first year, and then 11,250 in that second year.
Yeah, that makes sense.
Okay, good. And yeah, anytime you guys want to chime in and attempt something or try something, I'm more than happy to do that. I don't like to put people on the spot by calling out and saying, okay, do it. But I'm always happy to have you guys volunteer. And I think it's good when we miss something in class because we won't miss it on the test. If we see ourselves miss that in class, we know we're going to practice that before a test comes. Any other questions? All right, let's go take a look at a ratio. Okay, and again, I warn you about this. In Accounting 102, you have a whole chapter on ratios between 15 and 20, I'm thinking. I've never really counted them all. And so your author is sprinkling them throughout Accounting 101 as they come up. Well, since we're talking about long-term debt in this chapter, it makes sense to use a common ratio called debt to equity. Now, the nice thing about this ratio is there's not much to memorize because it tells you in the name of the ratio what this is. It's debt, so total debt, to equity, total equity. So let me go ahead and compute one of these and then we'll talk about what it means. So debt to equity is a measure of a company's capital structure. As far as safety in terms of investing in a company, the debt to equity ratio is important because debt has to be paid back. It legally has to be paid back. Not only that, debt holders fall above stockholders in the liquidation preference if a company goes under. The debt holders are going to get paid first. So nobody loans money for free. That means not only do they have to pay back the principal, they're going to have to pay back the interest. And so the less debt a company has means the more equity a company has. So the lower this number, the better off the company is going to look. Let me give you an example. So for number one here, let's put this up. We're going to put the total debt. We'll compare it to the total equity. We'll divide the two. So we'll do debt divided by equity, and we'll get the answer. And then we'll talk about what that answer means. Okay, so let me do this for Atlas first, that first company. And let me wait a second. And then we'll interpret that answer. So I'm looking right here at Atlas. Okay, debt. Debt is another word for liabilities. Their debt is $80,000. Their equity is $100,000. We might even be able to do that in our head, but if not, we'll go ahead and do 80,000 divided by 100,000, and I'll put that in your notes so you don't wonder where that came from. Is 0.80. The best way to read that is 2:1. Okay, whenever we do ratios, debt to equity ratio, if you read it 2:1, it's going to help you interpret. So let me tell you what that means. For every dollar contributed by shareholders, the company owes 80 cents to creditors. Okay, for every dollar contributed by shareholders, the company owes 80 cents to creditors. So let me do one more so we can kind of compare them and talk about who has the riskier capital structure. So let's do Brian, and then I'll take questions and answer any questions you guys may have. The liabilities are $562,500. The equities $187,500. I'm going to divide these two. This has an answer of 3:1. Okay, so for every dollar contributed by Brian shareholders, the company owes $3 to creditors. So here's what this means. They have the much more riskier capital structure. They have a lot of money owed to other people. As a shareholder, what that means to me is it's going to be a while before they have any money to pay dividends because they got to pay those creditors off first. So investors typically like to see a lower ratio. As far as is there a standard or a benchmark, it really varies with the different types of companies that you have. So I would look at industry. I would look for industry statistics on that. In other words, if I was getting ready, Juan knows that I invest in Boeing. If I was getting ready to maybe and look at another aerospace company, I'd be pulling up Raytheon, Boeing, who are some other defense contractors. McDonnell Douglas congregated with Boeing. Can't think of them all. Raytheon, I think I mentioned that. I would be looking at the industry and companies that I was interested in. So that ratio I consider to be fairly simple because you just have to look at the words debt to equity, debt on top, equity on the bottom. All right, then the last one, I don't know if you guys have noticed this on a test, but every time we have a new topic, there's always a test question, usually multiple choice, about how the topic would be displayed in the financial statements. Okay, well, again, big picture, we're looking at long-term liabilities. And so this last question gives us a bunch of liability accounts, and they want you to do the liability section of the balance sheet. Okay, so the thing I really want to focus on is the new part of this chapter, how the bonds would be displayed. So I'm going to go ahead and do the whole little section of the balance sheet, but I think the focus here, the new part, is on how bonds would be displayed. So I think what I'm going to do is I'm going to go through each of these green numbers here, and I'm going to write myself a note on whether it would be a current liability or a long-term liability. I see almost all liability accounts, they threw you a curveball in here in that they used machinery, right? So we don't always use everything the author gives us. That's an asset. That's kind of strange. But I'm going to go through these and code them. So what's the definition of a current liability? Something due within 1 year's time. Anything due outside of a year's time is a long-term liability. So this first one, notes payable due in 5 years, that's a long-term liability. I'm going to put a little LT. And accounts payable, that is a current liability. And bonds payable, that's going to be long-term. And as soon as you see bonds payable, you need to start looking for the discount or premium because they're called adjacent accounts. They go one right next to the other. So as soon as you see bonds payable, there's going to be a discount or premium. It's right here. This is going to go with the bonds payable. So I'm just going to kind of put connecting arrows. These always go together. Machinery is a curveball he threw at you. That's actually an asset, so it would not be in the liability section. And the rest of these, by definition, are current liabilities. They're due within a short time frame. We have liabilities for wages, which we did in chapter 9, interest, which we've done in multiple chapters, and sales tax, which is due at least quarterly. So they want the liability section. That's what this chapter is practicing. So I'm going to head this up. Liabilities. This would be a balance sheet. You'd have your who, what, when at the top. And we'd have 2 sections, current liabilities and then long-term liabilities. So current liabilities are usually listed in the order that they are due, but I think your author just started at the top and went down to the bottom. So I think I have 4 current liabilities. I have accounts payable at the top here, and then I have these last 3. So let's go list those. Anytime you see a CL, we have accounts payable. I'll go back and fix my spelling mistake. Got accounts payable, wages payable, interest payable, and sales tax payable. And I'll go ahead and list those. I'm just copying these numbers from the top, from the green box. And if it's a classified balance sheet, which is the only type of balance sheet you guys should be doing now, we'll add them up. These are used for various ratios and so forth. So we would expect to see that. Here comes the new part, but let me see if you guys have any questions. The new part and what this chapter is about is long-term liabilities. Okay, so here's what I would tell you. Bonds have an account that goes adjacent to it. Bonds rarely, if you watch the last lecture, bonds rarely issue at their face value. And the reason that happens is because interest rates change all the time. So in the 2 years that it takes to float that bond, chances are that bond needed to be repriced through the use of a discount or a premium. And here we saw that they had a discount. So this is the new part. So here's how you show it. Bonds payable, and then directly below it, you're going to see either less the discount or plus the premium. Okay, in this case, we had a discount. So we're going to show that principal of $10,000 directly below it. and that adjacent liability account, we would show that discount. And then someplace next to it, this is what's called a carrying value. I want that in your notes if it's not in there from the previous lecture. Okay, I'm going to write this down. This is what is termed the carrying value. It's what the bond is currently being carried at on its books. If you watch the last lecture, the discount is eventually going to be used up. The goal of the accounting is by the time you're done, there will be no discount or premium left. It will approach zero in the amortization table. And so questions on that. I'm going to highlight that because that is the new part of this chapter, how the bonds are shown on the financial statements. And again, every time I enter something, my arrows change. So it's kind of a mess by now. I'll move them back. Okay. So the last thing, I think we had one more long-term note, I believe. Yes, it was that note payable, that very first item in the green box that's due in 5 years. We would see that appear here, 3,000. And so you would see total long-term liabilities. I would add those up. And then right after that, on your balance sheet, you would see total liabilities. How much debt is the company in? That would be the sum of the short-term and the long-term liabilities. Just like we don't like debt on our own books, companies prefer to avoid debt when they can. But we also realize, just like I wouldn't have, gosh, houses are crazy price. Let's just say a $500,000 house. I don't have $500,000 sitting around to go buy a new house, so we finance them. Financing is part of the American dream, I would even say. If you want to acquire assets, unless you're really wealthy or you have rich parents, you're going to have to take on some debt. And that's what this chapter was about, long-term liabilities. Questions on that? Too bad they didn't give us the total equity so we could calculate that ratio one more time, but they did not provide that. Okay, guys, so we are moving down the balance sheet. We've covered all the assets. We've covered current liabilities. This chapter covered long-term liabilities. That means when you come back next time, we'll be on the equity section of the balance sheet, which is the most difficult chapter. One, you might remember back to the equity chapter. I remember lecturing on the next chapter, the equity chapter. It might have been a year ago. We went and counted the definitions. There were probably 30 new definitions just in that chapter. Lots of terms and definitions. So this is one of those chapters. So is the bonds, by the way. This chapter and the next chapter, read, take notes as you read. I've even done an outline of it, which I do as a student and as a teacher. I outline the chapter so I have a good reference to go back to when I'm studying for the test. I would highly encourage you guys to do that for this chapter and the next chapter. It's going to take some time. You're more likely in these two chapters to make mistakes on your homework. That's the reason I'm begging you guys to try the homework early. So remember, Juan has a lot of Zoom hours during the week. I have office hours every day during the week, and I can Zoom if my office hours don't work with your schedule. And there's also those instructor tutorials, which I recently sent out, where you can Zoom with a live instructor throughout the week to get help with the homework. So what I want you guys to do is keep in mind the end is in sight. We only have 2 more chapters until you're done with this class. But the 2 new chapters that we have are no joke. They're hard. And the reason that I keep bringing this up is not to scare you, but to make sure that you allocate the appropriate amount of study time on them. This is not a chapter where you can wait until Sunday night and not get overwhelmed. So try the homework in the middle of the week so that you can get assistance with it.
Professor?
Yes.
When you talked about the 30 different definitions or the terms that are new, what really helped me was flashcards.
Me too.
And I just put the term on one side and then the definition on the other side, and that helped me last year, I think it was. Yeah, or the year before.
Yeah.
But yeah.
Yeah, I use flashcards to study with all the time. I just saw another spelling mistake. Some students like to make them by hand, like you'll see here on mine. I make mine by hand. There are also electronic programs if you would prefer to study them that way. There's Quizlet, which also has some built-in flashcards, but I 100% believe in my heart that when you write them out yourself, it's a whole lot more likely to stick up here than using somebody else's pre-built flashcards. Any other questions? And Juan expects more people into his Zoom room. I expect more people because these are hard chapters. And it doesn't work that way for all classes, right? My Accounting 102 class right now starts off really hard, and then it kind of lets up more towards the end of the semester. So while you guys, and I tell my 102 class all the time, my poor 101 students were on the toughest chapters right now, they're getting a break. Their level of difficulty is letting up a little bit. Okay, if you guys do have any questions, you can reach me in my office in the morning before class, or we can Zoom at a time outside of class if that doesn't fit. Thank you very much. I'll see you guys next time.